Today is July 24th, 2026, and this is the most important Friday in technology investing this year. This week delivered the most comprehensive single-week data point yet on whether the AI spending cycle is producing real returns, or whether the biggest capital investment binge in technology history is running ahead of the fundamentals. 5 major earnings reports, 5 different answers, and today, as the final results hit, Brent crude rose past $100 a barrel, with Houthi attacks putting Red Sea shipping at risk and Russian refineries suffering damage from Ukrainian strikes, while the Strait of Hormuz experiences sharply lower transit. The inflation story that froze the Fed in video 40, that briefly eased in video 41 when Iran tensions temporarily reduced, is back, harder than before. Let me give you the complete AI earnings week scorecard first. Then I'll tell you what the $100 Brent crude number means for everything we've documented this year. Then I'll pair it with the most relevant book possible for this specific moment, Only the Paranoid Survive by Andy Grove, the Intel CEO who built the world's dominant chip company by surviving every strategic inflection point the technology industry threw at him. Because today, Intel is reporting its best quarter in 15 years, and the question is whether its 310% stock gain in 1 year is a justified inflection point or a dangerous valuation trap. Welcome to Earnings Per Page. Honest finance, no hype. Hit subscribe. Let's get into it. Part 1. The complete AI earnings week scorecard. 5 companies, 5 stories, 1 week. Let me give you each one precisely. Company 1, Alphabet. Revenue up 22% to $109.9 billion. Google Cloud up 63% to $20 billion. The $462 billion backlog is real. Operating margin at 36.1%, a record. And yet, Google's stock fell after hours as the company's capex growth announcement spooked investors. Free cash flow fell 47% year-over-year in Q1 as capital expenditure accelerated. The franchise is extraordinary. The loose-shot investment is terrifying markets. Verdict: spectacular business, punished stock. Company 2, Tesla. Record deliveries at 480,126 vehicles. The EV maker's earnings are forecast to have grown by 25% from the year-earlier period. Tesla shares have fallen after 3 of the company's last 4 earnings releases, including an 8.2% drop on mixed Q2 2025 results. The car business is executing. The Cybercab timeline is slipping. The Optimus bet is unpriced. Verdict: record automotive execution. AI application timeline still unproven. Company 3, Supermicro. Shares surged after the AI server maker reported a record backlog. The shovel seller thesis from video 33 confirmed. Infrastructure supply wins when AI application revenue is uncertain. Verdict: the clearest winner of the week. Company 4, IBM. IBM also reported Q2 results after a pre-earnings warning caused a brutal stock drop last week. IBM partially recovered on the actual results. The pre-announcement had priced in most of the bad news. The AI software transition is real, but slower than the market originally priced. Verdict: the cautionary tale that started this week's AI reality check. Company 5, Intel. Intel reported its most significant revenue growth in 15 years, with a 25% year-over-year revenue increase, primarily fueled by a 59% surge in revenue from its data center and AI hardware segment, which reached $6.3 billion. CEO Lip Bhutan said AI is driving unprecedented demand for compute. Intel is supply constrained, with data center customers demanding more than it can produce. Intel raised its 2026 capital expenditure guidance to over $20 billion to secure necessary tooling, memory, and substrates. Verdict: the biggest positive surprise of the week. The comeback story no one fully believed is delivering real numbers. The complete scorecard. Shovel sellers and infrastructure suppliers won this week. AI application generators got punished for their capex, and the geopolitical backdrop got dramatically worse as Brent hit $100. Part 2. Intel's 15-year moment and Andy Grove's warning. Intel's 25% revenue growth was the fastest for any period in almost 15 years. Intel's shares have surged 310% over the past year, after the US government took a 10% stake in the company as part of an effort to support US chip manufacturing. The forward PQE ratios is close to 87 times. meaning investors expect not just revenue growth but improved profitability, AI business realization, and its foundry strategy entering a true harvest phase. Andy Grove published Only the Paranoid Survive in 1996. His central concept, the strategic inflection point, is the most important framework for understanding whether Intel's current position is a genuine turning point or an expensive hope. Grove defines a strategic inflection point as a 10x change in one of the forces that govern how a business competes. The kind of change that either kills companies that don't adapt or creates enormous opportunities for companies that do. Grove documented Intel's most famous strategic inflection point from 1985, when it faced the choice of continuing to compete in memory chips against Japanese manufacturers who were producing better chips more cheaply. Grove famously asked his partner Gordon Moore, if we got kicked out and the board brought in a new CEO, what would he do? Moore said, get out of memory chips. So they did. Intel pivoted entirely to microprocessors. The rest is computing history. Today, Intel faces an analogous inflection point. The AI computing market is creating a 10x shift in the demand for specialized chips. CEO Lip Bhutan said Intel is the only company that can design, manufacture, and build the entire range of computing solutions from general-purpose traditional CPUs and GPUs to more purpose-built SiCs and CPUs optimized for agentic AI. This claim is strategically important. NVIDIA dominates GPU training chips. TSMC dominates advanced manufacturing. Intel's bet is that the next phase of AI, agentic AI, inference computing, custom silicon, rewards companies that can do everything in-house. Intel said it had reached 10 long-term agreements. Investors are keen to learn about possible contracts, including rumored deals with Apple and confirmed work for Tesla to expand Intel's manufacturing business. If Intel can convert its AI demand tailwind into a genuine foundry competitive position, combining chip design A&D manufacturing, the 87 times PE is a strategic inflection point premium, not a valuation trap. If the foundry business continues operating at a loss while GPU competition intensifies, the 310% stock gain will reverse dramatically. Grove's warning in Only the Paranoid Survive is precisely applicable here. The companies that survive strategic inflection points are the ones that recognize them early and act decisively. The companies that fail are the ones that mistake a temporary tailwind for a genuine inflection and keep investing in the old model when the new model is already winning. Intel's management believes it's at a genuine inflection point. Markets have priced in an 87 PE on that belief. The next 4 quarters will prove or disprove it. Part 3. $100 Brent crude and why it changes everything. Brent crude rose past $100 a barrel as Houthi attacks put Red Sea shipping at risk and Russian refineries suffered damage from Ukrainian strikes, while the Strait of Hormuz experienced sharply lower transit. $100 per barrel is a psychologically and practically significant price level. Psychologically, the last time Brent sustained above $100 was the post-Ukraine invasion spike of 2022. That spike triggered the inflation surge that the Fed responded to with the fastest rate hiking cycle in 40 years, which caused the worst 640 portfolio year since 1937. The housing affordability crisis, the credit card survival debt crisis, and every other financial pressure we've documented this year. Practically, $100 Brent directly and immediately affects 3 things. First, US inflation. Energy is approximately 7% of the CPI basket. When Brent rises from $80 to $100, a 25% increase, energy's contribution to CPI rises significantly. The June CPI reading of 3.5% that we celebrated in video 41 was partly driven by energy price relief. $100 Brent reverses that relief immediately. Second, AI data center operating costs. Every major hyperscaler, Alphabet, Amazon, Microsoft, Google, operates data centers that consume enormous quantities of electricity. Electricity prices are correlated with natural gas prices, which are correlated with oil prices. When Brent hits $100, the operating cost of the AI infrastructure that Alphabet just committed to building through its $462 billion backlog rises simultaneously. The margin pressure on AI infrastructure is already visible in Alphabet's falling free cash flow. $100 oil makes it worse. Third, the Federal Reserve's rate path. We covered in video 40 how Kevin Walsh's data-dependent approach makes every CPI reading a potential market-moving event. $100 Brent means the next CPI reading, August data, will likely reverse July's disinflationary progress. The October hike scenario that we said was less likely after the 3.5% June reading is back on the table. Markets will price this immediately. Part 4. The complete 2026 AI investing framework. After 5 earnings reports, here is the honest synthesis after the most important earnings week of 2026. The AI boom is real. Intel's 59% data center revenue growth is real. Alphabet's 63% cloud growth is real. Supermicro's record backlog is real. The demand is documented, committed, and accelerating. But the AI boom has a specific structure that this week's earnings revealed with more clarity than any previous data. Tier 1 infrastructure suppliers win most reliably. Supermicro, Vertiv, Bloom Energy, and Vent. These companies sell tools regardless of which AI model wins. Their revenue is driven by capex commitments, not AI application revenue. This tier had the best week. Tier 2 semiconductor manufacturers win with more volatility. Intel's data center segment up 59%. NVIDIA's position continues to strengthen based on GPU AI training demand. TSMC's advanced manufacturing is supply constrained, but these companies face valuation risk. Intel at 87 PE, NVIDIA at elevated multiples, that creates downside when execution stumbles. This tier had a complex week. Tier 3 AI application generators win eventually but face near-term uncertainty. Alphabet's cloud backlog of $462 billion is the strongest possible signal of eventual AI application revenue. But the capex to revenue lag is real and creating near-term stock pressure. This tier was punished this week. Tier 4 AI application users, mixed results. IBM, ServiceNow, Netflix, companies using AI to improve their own products. Results vary by execution quality and customer demand timing. This tier was the most volatile. The investment implication, at current valuation levels, and with $100 Brent crude adding inflationary pressure, Tier 1 remains the most reliable position. Tier 3 is where the long-term wealth creation will likely concentrate. Alphabet's $462 billion backlog will convert, but the path is volatile and the near-term stock action reflects that volatility. Part 5. The Iran escalation, the 5-week arc completed. Today completes a 5-week arc this channel has been tracking. Week 1, video 37, gold at its all-time high, Iran as a key driver. Week 2, video 40, Fed cancels rate cuts, Iran pushing inflation. Week 3, video 41, inflation drops to 3.5% as Iran tensions temporarily ease. Week 4, video 44, Iran peace deal collapses, service members killed. Week 5, video 46, Brent hits $100 as Houthi attacks and Russian refinery strikes combine with Hormuz transit reduction. This is what this channel does differently from individual news stories. We track the arc. The single data points are connected by a narrative that most coverage doesn't assemble. The 3.5% June CPI was not a new trajectory. It was a temporary relief within an ongoing geopolitical disruption. The $100 Brent crude today confirms that. The Fed meeting on July 29th, next Tuesday, just became the most consequential FOMC meeting of the year. Walsh said he'd be data-dependent. Today's data, $100 Brent, accelerating geopolitical risk, strong earnings that still show capex pressure, gives him genuine reason to lean hawkish in his language even if he holds rates unchanged. Part 6. What to actually do, the honest July 24th framework. Here is the practical synthesis for your portfolio on the last trading day of this extraordinary week. On cash, high. Yield savings accounts at 4% remain the most attractive they've been all year given the re-escalation of inflation risk. $100 Brent is a sign that the next CPI reading in August will not extend July's disinflationary trend. Cash earns while you wait for clarity. On gold, Brent crude rose past $100 is the most direct possible signal for gold. We identified gold as a diagnostic tool in video 37 and described it as benefiting from both geopolitical risk and inflation simultaneously. Today's oil price move checks both boxes simultaneously. On energy stocks, the only sector that finished positive in last week's semiconductor sell-off, energy stocks have fundamental support from $100 oil. If you have no energy exposure, today is a moment to consider modest addition. On AI stocks, the earnings week scorecard says own Tier 1 infrastructure suppliers for reliability, own Tier 3 application generators for long-term conviction with near-term volatility tolerance, be selective in Tier 2 semiconductors where valuation matters enormously. On Intel specifically, at 87 times PE with 59% data center revenue growth and a supply-constrained position, Intel is a strategic inflection point bet. Grove's framework says these bets pay off over 3 to 5 years if the inflection is genuine. At 87 PE, you're paying for a genuine inflection. If you believe Lip Bhutan's claim that Intel can dominate agentic AI computing as the only company that designs A&D manufactures, the valuation has a path. If the foundry business continues to struggle, the 310% gain reverses. Final verdict on only the paranoid survive. Should you read it in the context of Intel's earnings today? Absolutely yes. Grove's account of how Intel survived its own existential crisis in the 1980s is the most honest available framework for evaluating whether Intel's current AI positioning represents genuine reinvention or expensive hope. My rating? 10 out of 10. One of the most actionable business and investing books ever written. The strategic inflection point concept alone is worth the read. The honest bottom line for July 24, 2026. The AI earnings week is complete. The scorecard is clear. Shovel sellers won. Application generators got punished for their capex. Intel reported its best quarter in 15 years and raised guidance. And Brent crude hit $100, bringing back every inflation, Fed rate, and household financial pressure that briefly eased in June. This week did not resolve the AI investing debate. It clarified the terms of it. The AI boom is real. The revenue is coming. The path is volatile. The inflation backdrop just got significantly harder. Position accordingly. If this series has given you the most honest picture available of the 2026 American economy and technology landscape, subscribe to Earnings Per Page. Drop a comment with your honest verdict. Is Intel's 310% gain a justified inflection point or a dangerous valuation trap? See you in the next one.